from an economic perspective. But before I turn it over to Jeff, just for a couple housekeeping notes, there's no dial-in for this audio. It is all going to be done through your device. There is the ability for everyone to ask questions if there's any questions that come up during the presentation with the Q&A button on the left-hand side of your screen. If you, for some reason, have any technical issues during this webinar, I first recommend refreshing your page before identifying our technical specialist through the Q&A box of an issue you had. And then just as a reminder, this is a recorded webcast, and copies of the slide will also be sent out to everyone who is in attendance. And if there's any time where we run out for questions, we will be capturing all of them, and Jeff and I can get back to you via email. So without further ado, I'd like to turn it over to Jeffrey Sherman, Deputy Chief Investment Officer for DoubleLine, for today's presentation. So over to you, Jeff.
All right. Well, thanks, everybody, for joining. As we talk about the economic data, and we're using a lot of good refinitive data today to illustrate some of these ideas, I thought it was fitting to call this a global pandemic and a Fed-fueled frenzy. We like alliteration in there at the end. The Fed-fueled frenzy seems to be very appropriate when we think about the economic data. So without further ado, let's just jump in. And so if you take a look at the screen right here, what we've done is we've put together the world GDP forecast by year. And what you see here is that it was a pretty stable growth environment across the globe for the last 5 years or so, hovering, at the low end of the range, about a 3% range, at the top end of the end, a high 3% range, like 3.7 or so in 2018. We hit about 3% last year, and then the pandemic hit. So you saw this by some of that pressure on global growth was the pandemic hitting first on the eastern part of the globe, and then it trickled over to the developed world where we really had some ramifications. And notice here that these revisions continue to come in. They continue to come to the downward side as there's more pressure here, and the likelihood of the recovery, or at least the magnitude of the recovery, is to be a little more muted than thought maybe a couple months back. And a lot of that's related to really what's going on here in the U.S. And the U.S. holds the accolade as being one of the #1 contaminators of the coronavirus today. Not only do we have the most cases, with the most deaths on the per capita, there's a lot of things that are quite negative about the U.S. However, one thing you do see here on this chart on page 3 is that this is the drawdown in GDP. So the U.S. has one of those abnormal things where when we quote GDP in the U.S., we don't talk about cumulative GDP. We always report it on a quarterly basis and an annualized rate. So what you've seen thus far is you've seen the drawdown being around 31, 32%. I think it's 31 something on an annualized basis in the second quarter. I think that's the latest revision. But what we've done here instead is just take this from the high in GDP and look at what the drawdown is. And so if you look at previous recessions, what you can see here is that there's been a significantly less drawdown in GDP. Notice even during the recession in the tech wreck, what you see here is that there really wasn't a significant drawdown in GDP. But here we have a big hole to crawl out of. And so as the math works out, when you're down 10%, it doesn't take 10% to get you back to that high. It actually takes an 11% gain. That's just the thing of geometric growth. But what we see here is a huge drawdown that's really unprecedented since post-World War II. And so we have some digging out to do. And in order to do that, what we've seen is a response mechanism both from the Fed as well as the fiscal authorities in the U.S., aka Congress. And so when we look at what's happened, what we've seen is unprecedented amount of policy response. That policy response has led to some higher economic activity. So what we saw was the Fed cut rates. They slashed them very quickly. In the middle of March, they announced unlimited QE, or they announced the QE program, then it went to unlimited QE. Now they've dialed it down to $120 billion per month of bond purchases between treasuries and agency mortgages. To put that in perspective, at peak QE3, when the Fed was dire doing QE3 for that year in 2013, roughly they spent about $80 billion a month. That was the peak at that point before they started to taper down those purchases. So we're doing it bigger, better, faster, 50% more than the last time. And what that's done is it's helped bring some stability to financial markets. One, it's brought some stability and this commitment that the Fed will pursue a low interest rate policy for a long period of time. I'll talk about that in a bit. But also what we've seen is also the response from Congress with the CARES Act being $2.2 trillion of incremental spending. That's on top of the trillion-dollar budget deficit we were already looking at doing for this year. And there's talks of Congress once again adding to that amount. Those talks, I think, have been stalled because of the death of Ruth Bader Ginsburg. And so now this whole talk about trying to scramble to replace this looks like more politics as usual and just more madness going on there, not really focusing on what's good for the well-being of the constituency, but more for political agenda. That said, and not to be political here, but what we've seen is this response has led to increased economic activity. So the Fed has launched out what we see here on page 4, a great data series from Refinitiv here from the New York Fed. What it shows here is real-time data of economic activity. You can see this is highly correlated. We have overlaid GDP here. It's highly correlated to the GDP aspect as well. So what this kind of indicates is that what we'll see is an increase in economic activity in the third quarter, and we'll probably cut this drawdown roughly in about half by the third quarter. But remember, during the third quarter, what we saw was a lot of fiscal stimulus. We had these continuation of those policies from the CARES Act, not to mention the increased unemployment benefits that are being supported that ended at the end of August. And so although we've seen some increase here, we expect this to kind of stall a little bit unless there is either one of two things: more support through transfer payments from the government to those who are unemployed, or really a big recovery in the jobs market, which I'll cover later on as well. So again, at least we're digging ourselves out of the hole. I guess you could argue this looks like a V-shaped recovery at this stage. However, it's a lot slower on the upside than it was to the downside on that drop there. So another way to think about this is look at some group that Citigroup puts out. Citigroup puts out some economic data change series. And what these do is they amalgamate a multitude of economic data points, and they compare them to their average over the last 1 year. So it essentially says, where is the economic activity today relative to where it's been on average for the last 12 months? And you can see there that it was dire. The scales weren't even met for this. You can see in the U.S. down minus 5,000. The numbers on importance, the magnitude, you can see the changes here. And what you're starting to see here is that economic activity, again, at the amalgamated level, seems to look relatively close to where it was about 12 months ago. And so, again, a lot of this is coming through the data series that we'll show going forward. But you can see here that China has already usurped where they were on average 12 months ago. Remember, the virus broke out there in late third quarter, early fourth quarter, so they had a head start on this as well. But notice that the U.S. had a disproportionate impact to the downside and did have a significantly more rapid recovery, again, when you look at aggregated data. But let's distill this down and look at it. Before we do, one thing I want to look at here, there's a heat map here. There's a lot of numbers on here. It's something that my team puts together at DoubleLine. And what we do is we look at the PMIs and we compare them to where they've been trending over the last couple of years. And so you can see here, green is good, red is bad. And that's really what you should take away from here, is that what you find is that the manufacturing data, so if it's green, the darker the shade of green, the more extreme it is in terms of an expansion. When it is green, it is slightly expanding. The yellow is neutral, and then the orange is a contraction. And so you see here that it's a mixed bag so far. You see places like Mexico, that's not Mexico, that's Brazil, that are thriving here on the manufacturing front. Again, there's just been a lot of fiscal stimulus and pouring money into that. What you also see is that the U.S. has a strong manufacturing number. So we're starting to see the manufacturing pick up as people are trying to look beyond the pandemic. So another thing that has been important to do is to look at what I call some non-traditional series. And what I mean by non-traditional is just they're not really economic data series, but they're ways of trying to think about how our response has been to the pandemic and how economic activity could be picking up. And so what you see here is Apple Mobility. And if you go back to April and May, you can see that this is rerouting requests or routing requests on people's phones. So it's not a good measure of economic activity. It just says, are people moving around and looking for things on their phone? And so you can see here that the baseline is the beginning of January of 2020. It's the middle of the month. That was kind of the baseline. You see surges on the weekends when people are traveling. So there is some kind of weekly seasonality in there. But what you also see is the fall off in Italy, early on. Remember, that's when the pandemic broke out. That was when the first lockdowns happened. You can see the lag on the other side of data, and you can see this recovery. And so back in May and June, the bulls, the V-shaped recovery folks saying, look, rewriting request activity is out there. And ultimately, that it looks like we're back to normal. But also remember, those writing requests could be, hey, I'm just walking down the street. I'm looking for doing something. So maybe it's just people leaving their house, not truly the same level of driving and the like. So although this series is interesting to see, seeing Italy be 2x the request where it was back in January, I'm not sure how to interpret that. But there was a lot made about this. I don't really glean much from this information, except it says at least people are using their phone, and Apple is indeed spying on you to do that. So that's about all I glean from that. One part of activity, economic activity, is dining out. And so Open Table has been very generous with their data source that they publish this data. And what it does, the baseline is 0, and you look at the year-over-year change in bookings. And so it just compares the current week's data relative to 1 year ago. And so you can see back in March when we imposed lockdown, shut everything down, there was nobody making reservations and dining out. You can see where the early kind of reprieve on the lockdowns took place in late April, and you saw the activity come back up. You saw some spikes around Father's Day. It is kind of funny that it is Father's Day, people trying to go out to dinner or lunch and take their fathers out. Then you saw the dissipation again. We saw a little surge in cases. We've seen activity bounce back up. A lot of that spike you see there, like in Florida, is attributed to Labor Day weekend. Again, people being active, going out, and you can see it kind of falling down again. So it is very noisy data series. You can tell, look at Florida, how much there is in the volatility of that series, just swinging. And again, those are a lot of weekend bookings. You can see the spikes and that kind of weekly seasonality there. But this is something important as we think about the small business community and people getting back to this. Remember, a lot of just because that the reservations are roughly the same they were a year ago, remember, a lot of these places are operating on significantly less capacity. In my home state of California right now, restaurants can only be outside, they can only be outdoor, and up to 50% of the previous capacity. And the restaurants I've seen by going out, what you'll see is that they're probably operating 20 to 30% capacity of what they were prior to that. So good sign, doesn't measure magnitude, but it shows that we are getting activity back out there again. Another thing that's an important piece of our economy is travel. And so we all know that business travels are a big part of driving the economy for both hotels as well as from air travel. And notice here, too, this is TSA travelers. So this is the throughput through TSA. They publish this data every week. You can kind of see their spikes on the kind of business travel days. Now the spikes are kind of more correlated to the weekends again. And you can see there the big spike up towards the end of Labor Day. And we're just really in this sideways trend here. And what that is you're missing the business traveler. That's a huge component here. And you can see having roughly 600 to 800,000 people going through the security, sorry, I couldn't think of the word, versus 2.5 million roughly that we saw last year. And so that 2.5 million is roughly consistent over the last few years. So there's depressed travel here, and this is likely something that's going to be a headwind. So as investors, we need to think about this as well, is that the impact of business travel is going to have a big, it's going to have a significant impact, not just on this, through the airline activity, but also through the hotel industry, which is another big piece of the economy. So we look at hotel occupancy. What we did here is we took the range. We took 2009 because that was the last recession we had. The median over the last roughly 20 years. We took 19 just to show you what last year looked like, and then what it looks like this year. And so you can see typically hotels run, especially during the spring and summer months, something between 65 to 75% occupancy. So they're not at 100%. Yes, some areas are. This is the aggregate across the U.S. And so what we can see here is that there was obviously a huge drop-off, business travel being a key part of that. But then you found there's this recovery. But notice what happened about 7 or 8 weeks ago. The slope of that line flattened out a little bit. So this recovery is being slower and slower. And I wouldn't expect to see this uptick back to these previous levels. Again, we need to increase this by roughly 15 to 20% before we're out of the woods here. So There's a reason that people have been somewhat negative on the hotel industry, on the leisure sector in general. You're seeing activity come back. You're seeing some folks travel. They're not using airplanes to get there. They're driving more. And when you look at RevPAR, that's revenue per available room, what you're seeing, it's anywhere between 30 to 60% off of where it was before. So what you're finding there is that there's a reason this industry continues to be challenged. And again, to get the economy back to where we were, let's say in December of 19, you're going to need to see improvement in this. You're going to need to see the small business improve. You're going to need to see air travel come back. And also, you're going to have to see this leisure sector and business travel impacting the hotel side. Lastly, the other thing I like to look at is gasoline consumption. And so gasoline consumption is important because, one, it's one of our key drivers. This isn't because of Tesla or Nikola talking about pushing their car down a ramp and pretending that it drives on its own. But this is obviously because we all shut down and locked ourselves down for a while and didn't drive. And so we did there is we put the range. There's those two bands. The gray lines are the ranges, the low consumption over the last 5 years, and the high consumption, the median in there. And you can see we're almost back to that low area. So this is a good sign. This is a good sign for, again, the trucking industry is a big consumer. I know it says gasoline, there's diesel and stuff as well. But what you're seeing is that people are moving around again. I would actually expect this number to go higher when we actually get back to the recovery, because there's been a shift as people don't want to use public transportation. You've seen this in the surge and used car sales and more car sales out there as people, one, are afraid of taking public transportation. Secondly, maybe they're just weighing the benefits of having their own vehicle and trying to avoid it. So I'd expect to see us when we have a full recovery to be north of this kind of range that we saw in the past. So positive signs here that we're getting back to it. So there's mixed signs coming from this more real-time data, and that's what I want to talk about. So let's talk about how we've attacked this crisis as well. So I call it a Fed-fueled frenzy, but really, Congress definitely helped out significantly as well. And so what we want to do is show what the response mechanism has been from roughly the G7 here, which you find these are just the biggest economies in the world outside of China. And you can look here, this gray bar says what the current fiscal stimulus has been as a percentage of GDP. And so the dollars are always larger because the economies grow, so in nominal dollars, they're larger each time you go forward. But notice as a percentage of GDP. You're talking about unprecedented amounts. In the last crisis, which was a huge crisis, right? It was a financial crisis that took years to dig out of. We did anywhere between half to a quarter of the amount of stimulus that you're seeing here. In the case of the UK, they did only 25%. They did 4x what they did in the last crisis as a percentage of GDP. So the US has done a significant amount to put that in there. But notice that when you think about this fiscal stimulus, back in 2008, it was fiscal stimulus. It was money being lent out to programs. It was being trying to get lending back into the economy, trying to get things to get a money multiplier effect. This one, as I'll show you in a few slides, has been more along the lines of just delivering transfer payments to people to really help them get through this. So it's been a huge amount, and I don't think we're done yet. I think at this stage, if we stop trying to provide support, what you'll see is that the economy will sputter for a bit. So it is important that we continue. Either we have to continue to provide people with temporary income while they remain displaced during this pandemic, or we've got to get job creation back to those previous levels, and I'll talk about that in a minute. But if you look at how the U.S. spent its CARES Act, notice here a disproportionate amount went to large businesses. And so these are the local governments as well as large businesses got really the bulk of this when you look at it. And a lot of these entities didn't need it. They were able to borrow in the market. So there's been a disproportionate effect. That's why you see financial markets and the large cap stocks and a large cap space doing much better than some of the other areas of the economy, is because they have the ability to access capital. They've been able to do it cheaply. And what you see is, even though small business assistance is that big number, a lot of that was the Paycheck Protection Program, I think it was PPP, out there, and that has since expired as well. So there's more stimulus that's needed in some of these areas. You can see one-time checks was the third one, tax cuts. I don't even know where the tax cuts came from, but the unemployment benefits are a piece. Those are gone as well. So the crux of this has already been spent. It's already been to the economy. And so remember, as we look forward, we got to say, what's next? So to put this deficit in perspective, here's what it looks like. So we've updated the data since August. That was early August. So now we have a new estimate from the what are they called? The Office Budget Supply. I can't think what they're called. Anyway, it's right there. It's the official budget estimates. The acronym is escaping me right now. But you can see here's a percentage of GDP. Notice that we are really in an unprecedented area. And notice you usually see the budget deficit increase significantly towards the tail end of the recession, right? It starts to ramp up. Notice this time. We had the recession, and instantly we had this response mechanism. So it's been a very powerful effect of the economy. But notice the scale. We've done it as a massive percentage. And usually it's because GDP is collapsing during there and you're increasing the budget. I mean, we did these things in big scale and big proportion here. So we'll have to see what this looks like on a go-forward basis. But it does present some problems for the future. And those problems are illustrated on page 15. As we look at the public debt to GDP ratio, you see here it's roughly 135% today. So people were worried about during post-global financial crisis, the amount of budget deficit. We had a lot of transfer from the government sector was out there racking up debt to kind of pay down private sector debt from the mortgage market implosion we saw in the late 2000s. And what we saw there is notice how that ramped up through the entire. So this whole recovery that we saw since the financial crisis has been fueled on debt. And so it's not just the nominal debt, it's as a percentage of GDP, it continues to grow up. And even in the great years, when we've been hearing about this purported best economy ever, it was still fueled by debt. Granted, it wasn't this big increase that we saw post-financial crisis or recently, but it was still continuing to go up. And this was in the good times. And this is something we were talking about last year, saying when the next recession comes, we know that it's going to be responded with a massive amount of debt. And that's what you see here is that our debt to GDP ratio is really, truly going off the charts. It's growing exponentially here. And like I said, given that Congress is talking about another somewhere between $1 to $3 trillion plan in the fourth quarter at some point, this number is going to continue to accelerate. So it's going to create a hindrance on future GDP growth. I guess the good news is that we have the central banks. That's what we see on page 16. These are the balance sheets of the three largest interveners across the world, I'll call them. The Bank of Japan, the ECB, European Central Bank, as well as the Fed, the U.S. Central Bank. And you can see here, at least the Fed, they're far behind the curve, I guess, when you think about the other sides. Notice the ECB, they were actually paying down debt in 13 or so. They were unwinding the balance sheets, not paying down the debt, but they were taking on the asset side and the liabilities of their balance sheet. And they were doing a good job of that until 15, and then they had to really ratchet back up the QE. But notice when they ratchet up QE, that's when we stopped. And then we went down this program. If you remember, Janet Yellen announced that they're going to unwind the balance sheet. It was just going to work out great. If you recall, in the fourth quarter of 2018, Jay Powell went out and said, it's on automatic pilot. It's nothing to worry about. We're just going to unwind $50 billion a month. It's going to be nothing. And all of a sudden, by the time they ultimately got there, boom, we got hit with Corona, and it was already causing some challenges in the market prior to that. So the Fed has increased its discussion significantly. It's increased its purchases significantly, and its balance sheet now is roughly about 36% of GDP. So it's still less than the 53 of the ECB or the 122% from the BOJ, but it's undeniable that central banks have been there trying to do whatever they can to prevent us from having volatility in markets. And so what we've seen is that the masters of the universe are now the three central bankers here, and they have a lot of burden on them because two of them are pursuing negative interest rate policy. One says they don't find value in it. That one is the Fed. And I saw a headline today that Powell, during his testimony, had said that we've done all we can. We were out of ideas because negative interest rates don't work. They're a detriment to really capitalism. They're a detriment to capital markets. So we'll have to see how that plays out. So for my chart of the day, this is the one I'm gonna extol as being the chart of the day, is that money supply, because people have been talking about is there some inflation going through the system as well? And so what you see is money supply. is the increase in the amount of money in circulation. And notice how large the increase in money supply on that top chart has been this year. It's undeniable that when you start to print, you put these big policies together, you are printing money. And when you're issuing debt, that is printing money. So if you issue treasuries, that is new money coming into the market. You can net it out with what you're paying down. But if you're issuing new and you're running a deficit, that's more money supply coming to market. So the reason we haven't seen inflation today is because the money multipliers went up, or the money supply has went up significantly, but commensurately velocity has fell off of a cliff. So velocity is the turning over of that dollar into the economy. And you can see here that money velocity had been in a downward trajectory. This is what happens when you have high debt loads, right? That marginal dollar of borrowing doesn't go as far. Think about when you get yourself deeper and deeper in debt, you're just borrowing to service, and it just becomes problematic. And so what we see now, where at least when we were printing money before, every dollar would turn over 2 times, we're barely transacting 1 time at this point. So this is why you haven't seen inflation today. Is you got to watch these numbers, though. The good news is money velocity, it is starting to kink over a little bit. And I'm sorry, money supply is starting to kink over a little bit. And so hopefully we don't continue to accelerate this rate, because if we do, it really could have the ability of pushing on inflation. So on an inflation note, too, there's 2 mechanisms for inflation. There's either you get true inflation or you get pressure on your currency. And so what you see here is that red line is the dollar index. It's the Dixie. The Dixie looks similar to the trade-weighted basket. It's not. This is heavily denominated to the euro, or heavily allocated. I think it's about 2/3 euro in it. So you've seen some of the strength that had been the weakness in the dollar index was driven by euro strength. But you see here is that this red line tends to be correlated to those shaded areas above. And the shaded area above is what we call the twin deficits. That's the current account balance as well as the budget deficit. And you can even see on the far right-hand side, really, if you see there's just that line that goes down, there's just not enough of it to shade that area. But if you pull these together, you'd see we're running a massive current account deficit along with a massive budget deficit. And historically, those directions, when those are expanding, that puts pressure on the dollar downward. We do think that there will be pressure on the dollar downward over kind of this median term. Currently, given that run in the euro, but there's a lot of sentiment there, we expect a counter trend rally in the dollar in the short term. So for the next couple of months, we expect the dollar to be a little bit stronger. That could lead to some market weakness. And again, as that happens, we'd want to put on some more dollar shorts on the book. So something to think about. I mentioned the counter trend rally. This is the chart I'm looking at here. When I talk about the counter trend rally, notice that little bounce off that trend line there. Again, just using some technical analysis here, you can see that it started to bounce off that a little bit. We think it could probably run in 97, 98 or so, something like that, before it kind of resumes its decline. So short term, we do think that the setup is there. The stimulus has been around. All that pressure that was putting downward pressure on the dollar materialized in the last couple of months. And so that's what we think about for the short term. I mentioned inflation. We should look at inflation, too, because this has been on a lot of investors' minds. I know a lot of clients I speak with are talking about inflation today. And so it's important to think about what's driving inflation. And so that yellow line is hard to see, but that's core goods. It's actually positive. That dotted line, that's the horizontal line, is the 2% number. That's on there because of kind of the 2% inflation targeting. But you can see here that really, on the basket, what's driving this is goods had been low. The yellow line's hard to see, but the goods were deflationary for a prolonged period of time. But what we've seen is services what we're driving this. So think about restaurants, hotels, things that you are consuming that aren't goods. Those tend to still be above that 2% number, as well as shelter. We got a pretty strong housing print today. So this is the thing to watch to see, are there things driving inflation? And again, we know that base effects will kick in next year. We're likely to see a 2% inflation rate early next year just because of those base effects. But we'll see if all this money sloshing around the system and all this debt that's been incurred leads to some form of inflation. We also look at leading economic indicators. This still says that we're in a challenged environment here. Very consistent with that New York Economic Index I showed you at the front. It's probably about half of its level or so. Still says that we're not out of the woods yet. When I look at the manufacturing surveys as well as the non-manufacturing and services, what we see here is it looks like we're out of the blue.
So if I'm at the BLS and have to call when is the recession over, remember they said we went in a recession at the end of February of this year. If I ignored the labor data, I would say we came out of the recession at the end of June. Because a lot of data series look like this, but we know there's fragility within those data series. We know that they've been highly influenced by capital markets as well as transfer payments from the Fed. So this is reflected in this data series when we look at the consumer confidence now. Great data series that we got from via Refinitiv here. What you see here is now consumer confidence is at a new cycle low here. I'll call it a cycle low because now we've had the recession. So confidence eroded. It started to bounce back, right? You got the I can breathe check, right? Everybody got stimulus. Then if you were unemployed, it's like, okay, what's going to come back? My job is only temporarily gone. Wait a second, now I'm getting furloughed. So you see this with the airline industry. You see this with the hotel industry where those what were supposed to be temporary job losses are becoming permanent. And now is the time that these corporations can do it because they had to commit to take the PPP money. You had to commit to keep people on for a prolonged period of time, and that has since expired. So what you see here is that the consumer now not feeling so good about things. Small businesses, which is the backbone of the economy. Remember, you'll see that this is a volatile series here in the optimism. Remember, small businesses drive a lot of economic activity. We all think about Amazon, the Walmarts, Targets of the world. But really, in your local community, this is what's driving economic activity. Your local restaurants, the things you go visit, your local cleaner, just that normal activity. And so small businesses are a very important part of our economy. Notice here that confidence waned for a long period of time going into the election last time. And you know what happened is that small businesses were going to be treated like large corporations, and they were going to be able to get this long-term, or they try to get this tax reduction there as long as you weren't finance, certain industries were carved out. And so that's why you saw that big spike there. Now what you've seen is it's come back a little bit, but we're starting to see this data set roll over. So this is important to look at. But what I was digging deeper into the data set is that Affinity Solutions puts out this time series that talks about the consumer spending behavior and looking at overall revenue in small businesses. And notice here that small business took a disproportionate hit in the drawdown relative to consumer spending, right? They got hit even further. They started to recover. Everything was moving in lockstep, but there's been a divergence for the last couple of months. And so that divergence is likely due to some of the shutdowns, the lack of travel being out there, because again, this is what kind of keeps a lot of these communities going. So small businesses have taken a disproportionate hit. There's time series you can see through Yelp data, where you can look at, for instance, business closures, and they do a good job monitoring it. They don't know if it's pandemic related or not. What you see is roughly, I think right now you've seen it's something to the magnitude like 40% of small businesses are closed. Now, are they permanent closures? Are they temporary? The pandemic will tell us that with time. But this is a disproportionate effect. So when you hear about, programs to small business and lending out there, Main Street program, I think it was called, from the Fed, that's trying to get money in these people's hands. But the problem is it's got to go through the channel of the banking system. And remember, the banks do underwriting, right? So they have to assess the quality of being paid back still. So even though these loans, they're not being spent in the magnitude the Fed had done, because the underwriting is saying, I don't think your restaurant is going to survive. I think the stat is like 85% of restaurants fail in the first 3 years in America. So you didn't have a good chance to start with. Now you got the pandemic on your side. So as you look at it, there's a reason the data looks like this. We've seen a lot of large-scale bankruptcies. It was faster than 2009. The drop was faster. The economic recovery looks a bit faster. We'll see if it stalls, if we get a double dip. I think without either some increase in the jobs, getting people back to work, or some more stimulus, we're likely to have that double dip recession by the first quarter of next year. The unemployment picture it was a beautiful picture. Look at that downward slope going into the pandemic. U6 is the displaced worker as well. So U3 is the official unemployment rate. U6 includes the underemployed. So these are people who are working, but they're working at the margin, or they're part-time workers. So you can see here, there's a big spike. There was that gap that didn't really close itself significantly, but there's a big spike. The official number is 8.4%. If you listen to Powell's testimony last week and his Q&A afterward, I'm sorry, not his testimony, but the FOMC meeting, he testified this week. But if you look at it, and you listen to what he's saying to, he's like, yeah, because of the surveys, we're not getting as much response. Maybe the unemployment rate's 3 percentage points higher or so. So the number is likely somewhere in this range between 8 to 14. So we do, just because, again, it's hard to get a hold of people, right? Because some people are displaced. You don't have the in-person interviews. You have to be more phone related, and those people tend to be more employed. So another way to look at it is to take just the pure unemployment claims. And so the blue time series is something called the continuing jobless claims. And so the BLS puts this out. This is a weekly time series, so it's great. You have to wait for those monthly jobs reports that everybody craves on the first Friday. It's typically the first Friday of every month. But this comes out on a Thursday. I think it's a week lag, when the pandemic ones that are in red are 2 weeks lag. However, what you see in these data series is that you can see how many people are continuing to receive benefits. So they have a claim and they're getting some form of unemployment insurance. That red bar that gets stacked into here as well are also a new set of unemployment assistance that was created through the CARES Act called Pandemic Unemployment Assistance. So these are people who are not eligible for the traditional form of unemployment. They could just have too short a job history, self-employed, gig workers, contract laborers. What you see there is that there's an incremental 14 million people that, as the last print, are receiving pandemic unemployment assistance. So although the jobless claims, the continuing claims is 12.6 million, there's another 14.5 million folks out there receiving an incremental assistance. So pulling this together, because it dipped down, let's say you extrapolate that, it's maybe 27 million or so right now, total people receiving some form of state or federal unemployment assistance. So that paints a much dire picture than what I had on the previous page, because this shows you how many people are being excluded from that series. So if you assume that the working population is roughly about 180 million people or so, and you take 30 million, that says 1/6 of the workforce is unemployed today. And if that's the case, that means we have a 16 2/3% unemployment rate. So that's the reason I think the Fed is cautious right now. He keeps talking about the uncertainty, and that's why they've given this commitment of that they're not going to touch interest rates for a long period of time. And so I talked about powerful charts. I'll call this the second most powerful chart. Maybe this is the chart of the year, even as we think about it, because this shows you the impact that this stimulus has had. So the blue line is real disposable income. So it's an inflation-adjusted number on how people's incomes look. And notice what happened. We entered a recession and incomes went up. Okay, this typically is post the recession. It takes a few months or quarters for that to happen, for it to go up, but it went up concurrently with the recession. How did that happen? It came from the transfer payments. Notice what happens. If you strip out the money the government gave you, that red line, all of a sudden you have a new picture, right? So you can see back in the financial crisis, that red line went down, right? Incomes were kind of flattish, but we supported it with the government. So they spiked just a little bit, but ultimately it went down when you strip that back out. Notice the big gap between these two today. So this shows you how dependent our economy has been on the government providing aid to people. So either we get people back to work, we get economic activity going, and there's no magic way to do that. We know job recoveries take significantly longer than the job losses occurred over. And so this is going to be a long slog back. So unless the government continues to pay people out and provide assistance to these programs, it's going to be very challenging to get back to previous levels of GDP. This is why you don't hear about the V-shaped recovery. You don't even really hear about the W or anything. People talk about the K. There's the winners, the losers, right? And there'll be some convergence at some point in time. It's because of this idea that what we've kept consumption afloat was through these transfer payments. It's a very, very powerful chart and something that all investors should really consider. And so you can see here, I break it out, transfer receipts as a percentage of personal income. This chart's amazing to me. When we first pulled it, we were baffled by, because it's not something we always look at. We're baffled that in good times, 17% of income was being driven by the government. Well, one thing is that's Social Security. Right, so that Social Security goes in there. Okay, so that makes sense why it's increased over time, bigger part of our population. But notice that spike right there. I mean, that just shows you everything that's transpired here is that what we did is we essentially gave people 1/3 of their income right? Effectively in aggregate, that's what this looks like, is 1/3 of the overall income was a payment directly from the government. And there's stimulus checks there. That's the reason it came down. The stimulus spikes it, plus then you have these ongoing unemployment plans. So my last chart too is savings rate. Again, this is unheard of in a recession. Look at here, the shade area is a recession. Notice savings rate went up in a recession. How does that happen? All of a sudden, recession happens, we're all going to save money. It's because those transfer payments came in. So it has been a recovery. I led this off saying it was a Fed-fueled frenzy, but really the government is complicit as well. And if you listen to the Fed speaking, and what Jay Powell has been telling everyone is that the monetary side, we're going to be as accommodating as we can. Maybe we'll launch some other programs. We don't need to at this stage. It's on you, Congress, to decide. So what that means, it's the shout out this time of year. I think we're 41 days away for elections. So what that means is, got to remind everyone, you need to vote. You need to get out there, and you need to make sure you're represented and your viewpoints represented out there. So it's your right as a citizen to do so. So please, everyone, make sure 41 days you get out and you exercise that right. So with that, Ben, I'll turn it back to you for any questions from the audience. And while we're doing that, I'll give you the important disclosures on the screen.
Sounds good. Thanks, Jeff. That was awesome. And we've got a lot of questions in, so I don't know if we're going to get through all of them right now, but that was a great presentation, and we really appreciate it. And some of the points you brought up were fascinating to me. I mean, the one thing, initial feedback I would say personally is that you clearly over on your team are looking at maybe not the traditional economic factors, which is really I think critical. And like you said, actually a lot of those for everyone on the call, you saw a lot of those were done in data streams. So I encourage you to contact your account team if you subscribe, or to subscribe to the data stream content, to also monitor that, as I personally believe also that it is a critical element to getting your insight and to generating that alpha. The first question that came in that I also had myself was, could you expand a little bit on the idea of your opinion of when you said the U.S. Economy recovered back in June? I'm curious if you could just elaborate a little bit on that point, on what you meant. It was really, I was very fascinated by that point as well.
Right. So I guess what I'm getting at there, if you strip out the economic data series and you take the entire economic data series you're looking at, and you strip out the labor market, you would have all the signals that we're in a recovery, right? That's what I was trying to say there. So I don't believe that we're in a full economic recovery by any means. Yeah, so please do not attribute that quote to me and say, this idiot at DoubleLine thinks that we're in a recovery. Because as I've shown you, there's still stuff that's lagging. So it's a disparate economy right now. There are haves and have-nots. I'd say it's a polarized economy. Like we've had polarization in wealth, polarization in income. Now you have in the economy. And I was listening to an economist speak yesterday, and he said something amazing. At least I thought it was amazing. He said, if you want to buy the fabulous five stocks, is what he calls them, the FANGs, or whatever permutation acronym you want to use, the high flyers. If you want to buy them at today's valuation levels, you are super bearish on the world. Wait, what? You want to pay a high multiple for something? How are you super bearish? Because you don't think anything else can compete. It's technology or bust. We're all going to stay home. This is the only way to think about it. I thought that was an interesting perspective, too. So what you've seen is that the markets are different than the economy, right? We all know that. We always talk about that when they're disconnecting. They eventually converge. And so what's happened here is that a lot of the mega cap names are tech names, and they've bolstered and they've thrived in this environment. So the part that's lagging is the consumption from the actual earnings, right? So earnings from the consumer. And that's the biggest part. You can't have a full-fledged recovery without a recovery in jobs. And so we need good jobs, we need high-paying jobs, we need jobs of the future. And so that's going to be the defining moment when you go into 2021. What does that look like? And then if we continue to have this virus, do we roll over? Because corporate America says, okay, we've seen this playbook before, we got to get leaner. Right, that's where the furloughs come. That's where the layoffs come, and so that is what I'm watching here. So, because the stock market, is up for the year, the technology sector is up 25+% for the year, does not mean we're out of the woods. It just means those companies have delivered on earnings, they've delivered on things. They trade at pretty dear multiples today as well. So, I just want to caveat all of that by saying that I am not calling for this to be a recovery yet. It's just the labor side is what's really lagging, but we know labor's critical.
Totally makes sense and totally agree. That's what I thought you said, but also I was like, oh, that is a pretty interesting point. But
yeah, someone probably tuned in just to that part, got that snippet, and closed the webcast. And this guy's crazy.
We can check Twitter after this to see if there's your face, and then recovery is in stake. We'll see if we're on CNBC in a little bit. The next question actually is in regards to bank loans. What are your expectations for bank loan losses in the near future? I thought that's a pretty interesting question as well.
Yeah, I've seen estimates, coming around 5% or so from the raise agencies thinking about that default rate. I think that's probably right. When you look at the bank loan market, it is extremely bifurcated. And what I mean by that, it's stratified off a rating. So the single Bs and above, which are the high quality junk, the single Bs is kind of the middle tier, then you have the double Bs. Is trading relatively well. Average price is probably in the mid to high 90s, depending on the loan, right? But then you go in the triple C market, and the triple C market is a wreck, right? I mean, the yield on it, if you aggregate that whole market, I think it's got a DM, or call it the yield to above LIBOR, call it 14+% today, right? That's not a healthy market to begin with. We know the covenants are bad. We know the recoveries will be lower too. So what we think about the bank loan market is you got to pick your spots. If you're going to do it today because of the Fed too and the coupons there, if you want to lend to that type of market, we prefer to go to the high yield market over the bank loan market today. Gives you slightly higher yield. Yeah, you're a little more subordinated, but there's better quality inside of the high yield market than inside of the loan market as well. So the triple C high yield market by comparison trades around 10% or so today. So if you kind of just if you assume the market's efficient, which it's not, that just shows you the quality difference and mix of those areas. So I'm not concerned about imminent defaults within the bank loan market today, but it will be significantly higher over the next year or two than what we've seen for the last 5 years or so. Makes sense,
and that's great insight, frankly, that I will be taking notes on. Next question is, so we've done this macroeconomic series, Jeff, and we talked about that. And one of our speakers back in April was talking about gold and the world of gold. And so I'm curious your outlook on gold from this perspective moving forward. Call it next quarter, next 2 quarters. What's your idea behind gold?
Gold's had a heck of a run. Kudos to those that have owned it. It's done a good job. It's up 20+% for the year, even with the slight retracement you've seen recently. We think that the case for gold is you need more stimulus, right? Because you want to devalue the currency, right? So you need the dollar to decline effectively. And as Congress has kind of been wavering about the stimulus, gold's kind of struggled again, right? Had a great run too. Yeah. So medium term, I'm not a seller of gold. I think it's medium term. It's kind of like, you want to add, if you got down to like 1,700 or so again, that kind of 17 handle, it would be a good point to buy as well. And I just wait for it to break out again if it never gets there. So it needs to go over 2,000 again. Remember the high was like 1950 previously, about 6 years ago. Then we hit over 2,000 and it struggled at that point. But also notice it's been highly correlated to the dollar. So as the dollar's had that counter trend rally, you've seen some weakness in gold. So I think if you think that more stimulus is coming, it's good to be a gold investor. I would advocate for some of that in anybody's asset allocation portfolio. I think that you may have a better entry point. And look, if you miss like $100 or so, it's probably going to go to 3,000 when it explodes, right? So I think you don't have to worry about it, but you may get a better entry point or so.
Makes sense. And actually, this is a pretty timely question to what we were talking about before we even went live, Jeff. Commodities in general, there was obviously a slide related to gasoline consumption in regards to people are maybe freaked out to fly, but okay to drive, right? That's kind of the motto in my house right now is everyone's willing to drive up to 4 hours, but the minute you get in the plane, no, ain't happening. Yeah. I'm curious on your outlook for commodities and the commodities market. Any insight or anything your team thinks sticks out?
Yeah, I think it's luxurious to fly right now. There's hardly any people at the airport. It's as cleanest I've ever seen it. I have taken a few flights post-pandemic, and I got to say that it feels completely different. Certain carriers as well give you a lot of spacing. may want to rethink that flying. It's actually a lot better than you probably think it is. I just use two masks, a mask and then obviously a DoubleLine mask over it to advertise while we're out there. So commodities, though, I think you need the dollar weakness again. I think commodities do look attractive. They've been underinvested in. There's still the supply side that as we get to recover too, if the stimulus gets spent on things like infrastructure and the likes, you've seen Chinese stockpiles kind of come back in things like copper and nickel in the last quarter or so. Copper is the thing that's been kind of quietly going up that a lot of people don't talk about. It's back over in US dollar terms. It's over $3 a pound now. So there is some attractiveness there. And we see typically when we get some inflation, that's an area that gets it as well. So I do like the commodity story here. We are we're not bullish on the commodity story completely, but we're definitely above neutral on it and looking to add to those positions, especially once we see that dollar weakness take off. I think it's a good way of playing it. So there's obviously gold, but don't forget some of those other commodities can do it as well. And we start to see some food inflation being talked about as well. So I think the basket of commodities is interesting, where I've really only liked to focus previously on precious metals and industrial metals. I do think that that's interesting. Obviously, oil is going to zig and zag, off of this production that we've had. But I do think that long term, it's good to own some commodities in your portfolio.
Yeah, it makes sense. Absolutely. Completely agree with you, actually, in that front. We have two more questions, Jeff, and then we'll be conscious of everyone's time. The first one is in the near-term growth for the economy. What areas do you personally think could do the best? I know we saw some slides earlier regarding that, but if you're thinking near-term growth, what areas should we focus on a little bit, or where do you think is possibly the highest growth, or the people that can get out of this the quickest?
Well, I mean, it depends on kind of your take on things. So what I would say is that I would want to buy things that are kind of real asset linked, right? Because we're talking about commodities and things that we need, right? So I think of infrastructure-related assets as being a perfect area. I think about, continuation of the solar trend, right? These renewable energy resources, and maybe getting a bit off of the oil side. I did notice one of the analysts posted in one of our local chats, internal chats. He said that they're listening to water future. The water's futures are about to come, which I'm like, oh, great. But it's something that, is important, right? As we think about things. So, healthcare is still going to be a big driver. Tech is still going to be a driver. But what about industrials again? There could be this resurgence back there as well. So if we're going to continue the tiff with China, we're going to continue tariffs and penalizing, and we're going to go after the Chinese, and we're going to start manufacturing things ourselves, I think that's kind of a more longer term view, but that could be something very attractive. And obviously, it's going to have a high cost of labor relative to the rest of the world. But I think we understand now the needs for it. So I think we're gonna see that the pandemic changed a lot of behavior. We're going to go away from this, on-demand inventory systems. I forget what the accounting name for it is. But you're going to start stockpiling and stuff. You're going to go back to traditional things because we can't rely on the rest of the world to serve us in these capacity. We saw that. So I think the redefinition of supply chains is something to really be thinking about. Definitely very bullish on infrastructure because of how poor it is in this country. And we need a change. We need to spend money on things like that have a money multiplier. So private investment there will be some great opportunities, maybe not for growth, but for investing opportunities in this leisure sector, in commercial real estate. People don't want to touch it right now. They're saying no one will ever go back to the office. Well, never is a dangerous word, especially in investing. And there are some very interesting opportunities to take over some of this stuff. So I think that, there will be interesting ways to make opportunity, even if it isn't per se growth. It's because of distressed prices in those areas as well.
Makes sense. And I actually completely agree with you. The word never is a really bold word to say. Say no one's ever going back is a pretty bold statement. So we'll have this last question, and this is kind of related to obviously Refinitiv being a data company, and also I thought you did a great job of describing it. What indicators are your teams looking at right now, or what maybe unique data are you looking at right now that's a little maybe not your traditional data sets that you're really keeping an eye on to see whether we're in that that V, that K, that W. Yeah. I guess what indicators are you looking at right now, or what's really capturing your eye as an ending question?
Well, I think you saw some of that from the data we showed there, and you guys were very generous to provide me with some of that too. But what you see is things that are measuring more real time in the economy. You don't have to wait for more of the survey. So again, looking at business activity, I think it's very important to focus on the hotels and TSA throughput. When it comes to measuring small business activity, the Yelp data, I didn't get that in this presentation. That's an important one as well. Not just Open Table, but also Yelp, because it takes all types of businesses, not just restaurants, right? So, things that are trying to measure the pulse of the aggregate. It's not looking at the companies, the S&P 500. That's what's driving the stock market. But if we want to look at the economy, we need to know what's going on. So things you can get within, the real estate market. I didn't really cover real estate here because it's been hot. It's fine. There's all this movement right now. But a lot of data within there is very helpful. The forbearance data, making sure you're monitoring the consumer. So look at the forbearance and delinquency data when it comes to autos, to credit cards, to student loans. Those are other things that I didn't include today that I get out of the Refinitiv data set that I do think are very useful to people. That BLS data, on the unemployment claims is extremely important. Right, that was the thing we were monitoring, saying this is what we're going to monitor is initial claims to see when the recession's coming, and obviously that blew out of the water, right? So as you think about things, it's that you've always got to be open to think about it. You got to look around to see where you can get your pulse on the economy, and we had to throw away the playbook in a lot of cases, right? The traditional data is stale. So I just encourage people to dig in, talk to you guys. We've had a lot of conversation in building this book today with you guys, so you have the data series. There's a lot of stuff out there, and just inquire. If you want to know about specifics about healthcare, you can see hospital visits. There's a lot you can glean out there. So I just encourage everyone to continue to keep an open mind when it comes to the data sets.
Well, I couldn't say it better myself, Jeff. It was a pleasure working with you, and thank you very much for this presentation. We also got a lot of questions that just said this is a great presentation, so really appreciate you taking the time.
All right. Well, if they like it, let me give you one cheap plug, one shout out. We have a podcast called The Sherman Show. You can get it on iTunes, wherever you get your podcasts out there. We cover a lot of this stuff. We're going back to our every other week schedule. We got one next week, and so we'd like to talk to this. We talk to people out there. My next guest is someone who works in shared workspace. He's a CEO of a shared workspace entity. I think it'll be extremely fascinating. So that's another thing. It's a cheap plug for my product, but like I said, I think your viewers may appreciate that one as well. So tune into that also.
Well, I think I didn't realize that, so I will be subscribing, and I will be. My father's in commercial construction, so he will definitely also listen to that podcast as well.
All right, we'll have 3 views next week. Perfect.
Oh, all right, sounds good. Look forward to it.
All right.
Either way, thank you, Jeff. Really appreciate it. And thank you, everyone, for joining. This was an awesome session. Also, think about joining us on October 7th. My colleague, Olivier, will be leading a session with Stephen Riccido, who is the Managing Director and Chief Economist at Mizuho. That will be on October 7th. We did also get a lot of questions on the slides. They will be sent out after this session. Give it a couple hours, and they will be sent to your email. But thank you again, Jeff. This was awesome. We hope to do this again, and we look forward to continuing the conversation. And thanks, everyone, for joining. Stay safe, and look forward to seeing you all soon.
Thanks, Ben. It was great. Had a great time. Take care.
We are free.
Sweet. Thanks, Jeff. That was awesome.
Right.
I literally got a bunch of texts from my colleagues. It was great. So thank you very much.
Okay.
It was really appreciated.
Excellent. I tried to throw in some plugs to you guys in there as we're doing it. So hope that was good.
We appreciate the plugs. That was epic. I apprate it.
Okay.
That was really, really good.
All right. Okay, I got to hop, but thanks again. Thanks for everything. Take care. All right.
Talk to you soon. All right, bye.